Hello and welcome. Before we begin, I need to make something absolutely clear. Everything you're about to hear is general information only. This is not personal financial advice. Your circumstances are unique to you, so please always speak with a qualified financial advisor before making any investment decisions. Now, let's get started. Today, we're going to talk about something that might save you from making a catastrophic mistake. We're going to discuss the worst retirement investments for Australians over 50. And I know what you're thinking. You're thinking, I've worked my entire life for this money. I can't afford to get this wrong. And you're absolutely right. You can't afford to get this wrong. Because here's the truth. When you're in your 20s or 30s, you have time to recover from mistakes. You have decades ahead of you. But when you're 50, 60, or 70, time is no longer on your side. A bad investment decision now could devastate your retirement. It could force you to work longer. It could force you to rely entirely on the age pension. It could rob you of the comfortable retirement you've worked so hard to achieve. And the worst part? Many of these bad investments look appealing on the surface. They promise high returns. They promise security. They promise to solve all your problems. But underneath that shiny exterior, they're traps. They're designed to take your money and give you nothing in return. Or worse, they're so risky that they could wipe out everything you've saved. So if you've ever felt confused by investment options, you're not alone. If you've ever felt overwhelmed by financial jargon, you're not alone. And if you've ever worried that you might make the wrong decision, you're definitely not alone. Today, we're going to cut through the confusion. We're going to look at the specific investments that Australians over 50 should absolutely avoid. And more importantly, we're going to talk about why these investments are so dangerous. Let me start by acknowledging something important. You're scared. And that's completely understandable. You've worked for 40 or 50 years. You've sacrificed. You've saved. And now you're looking at your superannuation balance, wondering if it's enough, wondering if you've made the right choices, wondering if there's something you should be doing differently. And then someone approaches you with an opportunity. Maybe it's a seminar invitation in your letterbox. Maybe it's a phone call from a smooth-talking salesperson. Maybe it's an advertisement promising extraordinary returns. And for just a moment, you feel hope. Maybe this is the answer. Maybe this is how I secure my future. But that hope, that desperation, that's exactly what these bad investments prey on. They prey on your fear. They prey on your desire for security. They prey on the fact that you're running out of time and you need your money to work harder. And that's why we need to talk about this today, because knowledge is your best defense. Understanding is your shield. And by the end of today, you'll know exactly which investments to avoid and why. Now, let's take a step back and look at how we got here. Let's look at the Australian investment landscape and how it's changed over the decades, because understanding the context helps us understand the problem. If you're in your 60s or 70s today, you remember a very different Australia. You remember when bank interest rates were in the double digits. You remember when you could put your money in a term deposit and earn 10, 12, even 15% interest. In the 1980s and early 90s, interest rates in Australia were extraordinarily high. The Reserve Bank cash rate reached 17% in January 1990. 17%! Can you imagine? If you had $100,000 in a term deposit, you could earn $17,000 a year in interest. That was real money. That was enough to live on for many people. So an entire generation of Australians learned that cash investments were safe and profitable. You didn't need to take risks. You didn't need to understand the share market. You could just put your money in the bank and watch it grow. It was simple, it was safe, and it worked. But then something changed. The economy changed. Inflation came under control, and interest rates started to fall and fall and fall. Today, interest rates are at historic lows compared to those peak years. Term deposit rates have been sitting at much lower levels for years now. That same $100,000 that would have earned you $17,000 in 1990 might earn you just a few $1,000s today. That's a massive difference, and it's created a huge problem for retirees. Because many Australians still remember those glory days of high interest rates. They still think of term deposits as a complete retirement solution. They think they can just park their money in the bank and live off the interest. But the mathematics don't work anymore. The world has changed. And many people over 50 haven't adjusted their thinking to match the new reality. This has created a vulnerability, a gap between what people expect their money to do and what it can actually do. And into that gap have rushed all sorts of predatory investment schemes. High-risk investments, speculative opportunities, Ponzi schemes, scams, all designed to take advantage of people who are desperate for returns in a low-interest rate environment. There's another factor at play too: superannuation. The compulsory superannuation system only started in 1992. That means if you're in your 60s now, you've only had super for about 30 years. You haven't had a full working lifetime of compulsory contributions. Your super balance might be lower than younger generations will have, and that adds to the pressure. It adds to the feeling that you need to do something dramatic to catch up. And then there's the cost of living. Australia has become more expensive over the decades. Housing costs have risen dramatically. Healthcare costs have increased. The cost of energy, of food, of basic necessities, it's all gone up. So you need more money to retire than previous generations did. You need more money to maintain a comfortable standard of living. And that pressure, that squeeze, it makes risky investments look more tempting. So here we are. Interest rates are low. Superannuation balances might not be as high as you'd hoped. The cost of living is increasing, and you're feeling the pressure to make your money work harder. This is the perfect environment for bad investments to thrive, and that's exactly what we're seeing. Now, let's dive into the specific investments you need to avoid. And I want to be very clear here. I'm not going to sugarcoat this. Some of these investments are outright scams. Others are just incredibly risky and inappropriate for someone in their retirement years. But all of them share one thing in common: they can destroy your financial security. The first worst investment is speculative cryptocurrency. Now, before anyone gets upset, let me clarify. I'm not saying all cryptocurrency is bad. I'm not saying blockchain technology has no merit. What I'm saying is that for someone over 50 who's approaching or in retirement, putting significant money into highly speculative crypto assets is incredibly dangerous. Why? Because cryptocurrency is extraordinarily volatile. Bitcoin, for example, has experienced price swings of 30, 40, even 50% in a matter of weeks. One day it's soaring, the next day it's crashing. And at your age, you cannot afford that kind of volatility. You cannot afford to see half your retirement savings disappear overnight because some regulatory announcement was made or some exchange collapsed. And yet, the marketing around cryptocurrency is incredibly seductive. You see stories of people who bought Bitcoin for a few dollars, and now they're millionaires. You hear about incredible returns. You see advertisements promising that crypto is the future of money. And you think, maybe I should get on board. Maybe this is my chance to catch up. But here's what they don't tell you. For every person who made money in cryptocurrency, there are dozens who lost everything. The crypto market is unregulated compared to traditional investments. There's no government guarantee, no investor protection. If the exchange you're using gets hacked or goes bankrupt, your money could simply vanish, and there's very little recourse. Plus, cryptocurrency is complex. Most people don't truly understand how it works. They don't understand the technology. They don't understand the risks. They're buying something they don't understand because someone told them it would make them rich, and that is never a good investment strategy. The second worst investment is timeshare properties. Now, some of you might remember when timeshares were all the rage in the 1980s and 90s. The promise was simple. You buy a share in a holiday property, you get to use it for a few weeks each year, and you have a guaranteed holiday destination forever. Sounds great, doesn't it? But timeshares are almost always a terrible investment. First, they're not really investments at all. They're holiday expenses dressed up to look like assets. When you buy a timeshare, you're not buying something that will appreciate in value. In fact, most timeshares are worth far less on the resale market than what you paid for them. Try to sell a timeshare, and you'll quickly discover that nobody wants to buy it. Second, you're locked into ongoing costs, maintenance fees, management fees, special assessments, and these fees tend to increase every single year. You might think you're paying $10,000 up front for a lifetime of holidays, but over 20 years, those annual fees could add up to $20,000 or $30,000 or more, and you can't get out of them. Even if you stop using the property, you're still obligated to pay the fees. Third, timeshares are inflexible. You're locked into specific weeks, specific locations. What if your health changes and you can't travel? What if you want to go somewhere different? What if the property deteriorates or the location becomes less desirable? You're stuck. And the sales tactics used to sell timeshares are notoriously aggressive. High-pressure presentations, limited-time offers, emotional manipulation. They want you to sign on the spot before you have time to think it through or seek independent advice. That alone should be a massive red flag. The third worst investment is unlisted or unregulated investment schemes. These are investment opportunities that aren't traded on public exchanges like the ASX. They're private deals, and they're incredibly dangerous. These schemes often promise extraordinarily high returns, 12%, 15%, 20% per year. Returns that sound too good to be true. And guess what? They are too good to be true. These schemes might invest in all sorts of things: agricultural projects, property developments, mining ventures, renewable energy, and the promoters paint a picture of guaranteed returns with no risk. But here's the reality. If an investment isn't listed on a public exchange, there's usually a reason. It's either too risky, too speculative, or it's an outright scam. The lack of regulation means there's very little oversight. The promoters can make exaggerated claims, they can hide fees and commissions, they can misuse your money, and when things go wrong, you have very limited recourse. You can't just sell your investment like you could with shares or managed funds. You're locked in, and if the scheme collapses, your money disappears. Australia has seen numerous examples of these schemes over the years. Agricultural schemes that promised guaranteed returns based on growing sandalwood or almonds, property developments that never got built, financial Ponzi schemes where early investors were paid with money from new investors, and in almost every case, ordinary Australians lost their life savings. The fourth worst investment is single stock concentration. This is when you put a large percentage of your retirement savings into just one or two individual companies. Maybe it's because you worked for that company. Maybe it's because someone gave you a hot tip. Maybe it's because you believe in the company's future. But whatever the reason, putting all your eggs in one basket is incredibly risky. Individual companies can fail, even large, seemingly stable companies. Think about companies that were once giants and are now gone or diminished. Think about the Australians who had their entire retirement savings in company shares that collapsed. HIH Insurance, ABC Learning, Storm Financial, Babcock and Brown. These were substantial companies, and they all failed or faced massive problems. When you're young, you might be able to afford to take a punt on individual stocks. If one fails, you have time to recover. But when you're over 50, you don't have that luxury. A single bad stock pick could wipe out years of savings, and you don't have the time to rebuild. Diversification is crucial for retirement portfolios. You need to spread your risk across multiple companies, multiple industries, multiple asset classes. That way, if one investment performs poorly, it doesn't destroy your entire retirement. But single stock concentration ignores this fundamental principle, and it puts your entire future at risk. The fifth worst investment is high-fee managed funds or superannuation products. Now, this one is subtle because managed funds and super products aren't inherently bad. In fact, they can be excellent investment vehicles, but some of them charge such high fees that they destroy your returns over time. Let me give you an example. Let's say you have $200,000 invested. Fund A charges 1% per year in fees. Fund B charges 2.5% per year in fees. That 1.5% difference might not sound like much, but over 20 years, it can add up to tens of thousands of dollars in lost returns. High fees are like termites. They eat away at your wealth slowly and steadily. You might not notice them day to day, but over years and decades, they can consume a huge portion of your retirement savings. And the worst part is, high fees don't guarantee better performance. Often, the funds with the highest fees don't perform any better than low-cost alternatives. So, how do you know if you're paying too much? Look at your product disclosure statements. Look at your annual statements. If you're paying more than 1% per year in total fees for a diversified managed fund or super product, you need to question whether you're getting value. And if you're paying more than 2%, you're almost certainly paying too much. The sixth worst investment is reverse mortgages without proper advice. A reverse mortgage allows you to borrow money against the equity in your home. You don't make regular repayments. Instead, the debt grows over time, and it's repaid when you sell the house or pass away. For some people, in some circumstances, reverse mortgages can be a useful tool, but they're also incredibly risky if not structured properly. The problem is the compound interest. Because you're not making repayments, the interest compounds on itself. The debt grows exponentially. You might borrow $50,000 today, but in 15 years, that debt could have ballooned to $150,000 or more, depending on the interest rate. This can destroy your equity. You might think you're borrowing a small amount against your home, but years later, you discover that the bank now owns most of your property. And if you need to move into aged care, or if you pass away, your family might discover there's very little equity left for them. Reverse mortgages aren't always bad, but they require very careful consideration. You need independent financial advice. You need to understand exactly how the interest will compound. You need to think about the long-term implications, and you need to explore all other options first. The seventh worst investment is investing based on cold calls or unsolicited approaches. If someone calls you out of the blue offering an investment opportunity, hang up immediately. Legitimate investment opportunities don't come through cold calls. Financial advisors who are worth working with don't need to make unsolicited phone calls to find clients. These cold callers are almost always scammers, or they're pushing inappropriate high-risk investments. They use high-pressure tactics. They create false urgency. They claim the opportunity is exclusive or limited, and they want you to make a decision right now before you have time to think or seek advice. The same applies to unsolicited emails, text messages, or social media messages. If someone you don't know is reaching out to you with an investment opportunity, it's a red flag. Delete the message, block the number, do not engage. And be particularly wary of investments that claim to be endorsed by celebrities or government officials. Scammers often use fake endorsements to create legitimacy. They'll create fake websites that look professional. They'll use photos of well-known Australians without permission. They'll claim that their scheme is approved or regulated when it's not. The eighth worst investment is forex trading, or contracts for difference for beginners. Foreign exchange trading and CFDs are complex financial instruments. They involve betting on whether currencies or other assets will go up or down, and they use leverage, which means you're trading with borrowed money. The leverage is what makes them so dangerous. You might put in $1,000, but you're controlling $10,000 or even $100,000 worth of currency. If the trade goes your way, you can make spectacular profits, but if it goes against you, you can lose everything, and not just your initial investment. You can end up owing money. These instruments are designed for professional traders, people who understand the markets deeply, people who can afford to lose money, people who trade full-time. They are not appropriate for retirees who are trying to preserve their capital and generate steady income. And yet, there are countless advertisements targeting older Australians with promises of easy money through Forex or CFD trading. They show you fancy cars and luxury lifestyles. They claim you can make thousands of dollars a week from your computer. But the reality is that the vast majority of retail Forex and CFD traders lose money. Studies have shown that 70 to 80% of people who try these instruments lose their investment. The ninth worst investment is loaning money to family or friends without proper documentation. Now, this isn't technically an investment in the traditional sense, but it's a way that many older Australians lose substantial amounts of money. Your adult child needs money for a business venture, your nephew needs help with a property deposit, a friend is facing financial hardship. And because you care about these people, because you want to help, you give them money. Maybe you call it a loan. Maybe you expect to be repaid, but there's no formal agreement, no written contract, no security, just a handshake and a promise. And then the relationship deteriorates, or the business fails, or circumstances change, and the money is never repaid. And now you're in an impossible position. Do you demand repayment and destroy the relationship? Do you take legal action against your own child? Or do you just accept that the money is gone? This happens far more often than people realize, and it can devastate retirement plans. If you're going to help family or friends financially, treat it as a gift, not a loan. Only give money you can afford to lose. And if you do structure it as a loan, get proper legal documentation. Make it formal, make it clear. Protect yourself and protect the relationship. The 10th and final worst investment is doing nothing out of fear. This might seem contradictory. We've just talked about all these terrible investments to avoid. But doing nothing, leaving your money sitting in a low-interest savings account for years, that's also a mistake, because inflation will steadily erode your purchasing power. Many Australians over 50 are so afraid of losing money that they refuse to invest at all. They keep everything in cash. They think they're being safe, but they're actually guaranteeing that their money will be worth less every year. If inflation runs at 3% and your savings account pays 1%, you're effectively losing 2% of your purchasing power every year. Over 20 years of retirement, that can be devastating. Your $100,000 might still be there in numerical terms, but in terms of what it can buy, it might only be worth $50,000 or $60,000 in today's money. You've lost half your purchasing power by trying to be safe. So yes, avoid the risky investments we've discussed, but don't swing to the other extreme. Don't let fear paralyze you. You need a balanced approach. You need some growth in your portfolio to keep pace with inflation. You need diversification. You need a proper investment strategy. And that brings us to our case study. Let me introduce you to Bruce and Jenny again. They're 65 and 63. They've just retired. They have $400,000 in superannuation. They own their home, and they're trying to figure out how to invest their money for retirement. Bruce worked as an electrician. Jenny worked part-time in retail. They're good people, hard-working, sensible, but they're not financial experts. Bruce gets a phone call one day. It's a very friendly man who says he's from an investment firm. The man explains that there is an exclusive agricultural investment opportunity. It involves investing in macadamia nut farms. The returns are guaranteed at 12% per year, and it's very safe because it's backed by real assets, the land and the trees. Bruce is intrigued. 12% sounds amazing. His superannuation has been earning maybe 5 or 6%. This would more than double his returns. The man on the phone is very persuasive. He says there are only a few spots left. He needs Bruce to make a decision quickly. He offers to send over some glossy brochures. Bruce talks to Jenny about it that evening. Jenny is skeptical. It sounds too good to be true. She suggests they talk to their financial advisor first. But Bruce is worried they'll miss out. The man said the opportunity is closing soon. So Bruce calls back the next day and commits $100,000, a quarter of their entire retirement savings. For the first year, everything seems fine. They receive quarterly statements showing their investment is growing. They even receive a small payment, which they're told is their return. Bruce feels vindicated. Jenny is relieved. Maybe it was a good decision after all. But then the payments stop. The quarterly statements stop arriving. Bruce tries to call the investment firm. The phone number is disconnected. He tries to email. No response. He searches for the company online and discovers it's been shut down by regulators. It was a Ponzi scheme. The returns they received in the first year weren't real profits. They were just money from new investors. Bruce and Jenny have lost $100,000, a quarter of their retirement savings, gone. They're devastated. They blame themselves. They blame each other. They feel stupid and embarrassed. And worst of all, they now have to completely rethink their retirement plans. They can't afford the lifestyle they'd hoped for. They might have to rely more heavily on the age pension, and they've lost their sense of security. This story isn't unique. It happens to hundreds of Australians every year. Good people, smart people, people who just wanted to secure their future, but who got caught by a scam or an inappropriate investment. Now let's imagine a different version of Bruce and Jenny's story. Same phone call, same investment pitch, but this time Bruce's response is different. He tells the man on the phone that he needs to think about it. He says he never makes investment decisions without consulting his financial advisor. The man on the phone becomes pushy. He talks about the limited opportunity, but Bruce holds firm. He says he'll call back if he's interested, and then he hangs up. Bruce discusses it with Jenny. They agree to mention it to their financial advisor at their next meeting. The advisor listens patiently. Then he explains that guaranteed returns of 12% don't exist in the current market without significant risk. He points out red flags, the cold call, the pressure tactics, the promise of exclusivity. He suggests that this is likely a scam, or at best, a highly speculative investment inappropriate for their situation. Bruce and Jenny decide not to proceed. They feel a twinge of disappointment. What if it was legitimate? What if they're missing out? But they trust their advisor's judgment. They'd rather be safe than sorry. And 6 months later, they read in the newspaper that the agricultural investment scheme has been shut down by ASIC. Investors have lost millions. Bruce and Jenny feel relieved. They dodged a bullet. This time, they keep their $100,000. Their retirement proceeds as planned. They're comfortable, they're secure, and they sleep well at night knowing they made the right decision. So what's the difference between these two versions? Knowledge, caution, and proper advice. The second Bruce and Jenny understood the warning signs. They didn't let emotion or pressure cloud their judgment, and they consulted with a professional before making a major decision. Now, let's talk about what you should do. What are the practical steps you can take to protect yourself from these worst investments? How can you ensure you don't fall into these traps? First, establish a relationship with a qualified financial advisor, not just any advisor, someone who is licensed, someone who is required to act in your best interests, someone who charges transparent fees, not commissions on products they sell you. Interview a few advisors. Ask about their qualifications. Ask about their fee structure. Ask for references, and choose someone you feel comfortable with, someone you trust. Second, educate yourself. You don't need to become a financial expert, but you should understand the basics. Understand what superannuation is. Understand what diversification means. Understand the difference between growth assets and defensive assets. Understand what fees you're paying. The more you know, the harder it is for someone to take advantage of you. Third, be skeptical of any investment that promises high returns with low risk. This is the golden rule. In investment, risk and return are connected. Higher returns always come with higher risk. If someone promises you high returns with guaranteed safety, they're either lying or they don't understand what they're selling. Fourth, never make investment decisions under pressure. Legitimate investment opportunities don't disappear overnight. If someone is pressuring you to decide immediately, that's a red flag. Tell them you need time to think. Tell them you need to consult your advisor. And if they won't give you that time, walk away. Fifth, do your research. If someone approaches you with an investment opportunity, look it up. Google the company name. Check if they're registered with ASIC. Look for reviews or complaints. Search for news articles. If you can't find any information, or if what you find is concerning, don't invest. Sixth, understand what you're investing in. If you can't explain an investment in simple terms, you don't understand it well enough to invest in it. Don't invest in something just because it sounds sophisticated or because someone used impressive jargon. Complexity is often used to hide risk or to confuse investors. Seventh, diversify. Don't put all your money in one investment. Don't put all your money in one asset class. Spread your risk. A properly diversified portfolio might include Australian shares, international shares, property, bonds, and cash. The exact mix depends on your circumstances, your goals, and your risk tolerance, but the principle of diversification is universal. Eighth, review your fees. Look at what you're paying for your superannuation and investments. If the fees seem high, question them. Ask your advisor to justify the fees. Consider switching to lower-cost alternatives if the performance doesn't justify the cost. Ninth, be wary of investing in things you don't understand or can't verify. If you can't see where your money is going, if you can't understand how returns are generated, if you can't verify that the investment actually exists, don't invest. 10th, trust your instincts. If something feels wrong, it probably is. If an investment opportunity makes you uncomfortable, don't do it. If you have doubts, pause. Your intuition is often right, even if you can't articulate exactly what's bothering you. 11th, protect yourself from scams. Never give your personal information to unsolicited callers. Never click on links in suspicious emails. Never provide your banking details to anyone you don't know and trust. Be particularly careful of investment opportunities promoted through social media. 12th, have an investment policy. Work with your advisor to create a written plan that outlines your goals, your risk tolerance, and your investment strategy. Then stick to that plan. Don't deviate from it based on emotion or pressure or fear of missing out. Review it annually, but don't change it on a whim. 13th, keep your money in regulated environments. Invest through licensed financial advisors. Use investments listed on regulated exchanges. Use banks and superannuation funds that are regulated by APRA. These regulations exist to protect you. They provide oversight. They provide recourse if something goes wrong. 14th, be careful with concentration. Whether it's a single stock, a single property, or a single investment type, concentration is risky. Even if you're confident in that investment, remember that things can go wrong. Companies can fail. Markets can crash. Regulations can change. Protect yourself by spreading your risk. 15th, document everything. Keep records of all your investments. Keep copies of product disclosure statements. Keep records of conversations with advisors. Keep evidence of transactions. If something goes wrong, you'll need these documents to seek recourse or to report to authorities. And finally, 16th, remember that protecting your capital is more important than chasing returns. At your age, preservation matters more than growth. You can afford to miss out on some returns, but you cannot afford to lose your capital. Be conservative, be cautious, be patient. Now, I want to talk about the emotional side of this, because avoiding bad investments isn't just about understanding the technical details. It's also about managing your emotions, fear, greed, regret. These emotions can drive you to make terrible decisions. Fear can paralyze you. It can stop you from investing at all, leaving your money to be eroded by inflation. Or it can make you grab at anything that promises safety, even if that safety is an illusion. You need to acknowledge your fear, but don't let it control your decisions. Greed can tempt you. When you see others making money, when you hear stories of extraordinary returns, it's natural to want a piece of that. But greed makes you vulnerable. It makes you ignore warning signs. It makes you take risks you shouldn't take. Remember, if it sounds too good to be true, it is. Regret can haunt you. Maybe you made a bad investment in the past. Maybe you missed an opportunity. Maybe your superannuation balance isn't as high as you wish it was, but dwelling on regret doesn't help. You can't change the past. You can only make better decisions going forward. So be kind to yourself. Be patient with yourself. Understand that everyone makes mistakes. The goal isn't perfection. The goal is to protect what you have and to make sensible, informed decisions about your future. And that's completely achievable. Let me bring this all together now. We've talked about the worst investments: speculative cryptocurrency, timeshares, unlisted schemes, single stock concentration, high fee products, improper reverse mortgages, cold call scams, Forex and CFDs, informal loans to family, and doing nothing out of fear. These investments share common characteristics. They promise too much, they pressure you to decide quickly, they're complex or opaque, they're high risk, they have high fees, or they're outright scams, and they're all inappropriate for someone over 50 who needs to protect their retirement savings. But here's the good news. Once you know what to avoid, it becomes much easier to identify good investments. Good investments are transparent, they're regulated, they're diversified, they have reasonable fees, they match your risk tolerance, they're explained clearly, and they're recommended by qualified professionals who have your best interests at heart. You've worked too hard to throw your money away on inappropriate investments. You've sacrificed too much to hand your retirement savings to scammers. You deserve better. You deserve a retirement where you feel secure, where you can sleep at night knowing your money is working for you safely and appropriately. This is your third act. This is the time you've been working toward your entire life. And yes, managing your money requires thought and care. It requires seeking advice. It requires staying informed. But it doesn't require taking reckless risks. It doesn't require chasing impossible returns. It doesn't require investing in things you don't understand. What it requires is prudence, patience, and the wisdom to distinguish between genuine opportunities and dangerous traps. And you have that wisdom. You've lived long enough to know that if something sounds too good to be true, it probably is. You've seen enough to know that get-rich-quick schemes don't work. You've experienced enough to know that slow and steady wins the race. So trust yourself. Trust your instincts. Seek professional advice. Ask questions. Take your time and protect what you've built. Your retirement should be a time of peace and enjoyment, not a time of financial stress and regret. And by avoiding these worst investments, by making informed and careful decisions, you can create that peace. You can wake up each morning knowing your money is safe. You can make plans knowing you have the resources to follow through. You can help your family knowing you're not putting your own security at risk. You can live with dignity, comfort, and freedom. That's what you've worked for. That's what you deserve. And that's what careful, informed investment decisions can give you. So take what you've learned today and use it. Be vigilant. Be skeptical. Be cautious, but don't be paralyzed. Work with professionals. Build a sensible, diversified portfolio. Review it regularly. And then live your life. Enjoy your retirement. Spend time with loved ones. Pursue your interests. Travel if you can. Relax. You've earned it. And remember, before we close, everything we've discussed today is general information only. This is not personal financial advice. Your situation is unique. Your needs are unique. So please always consult with a qualified financial advisor before making any investment decisions. They can help you understand your specific circumstances and develop a strategy that's right for you. Thank you for spending this time with me today. Thank you for caring enough about your future to learn about these dangers, and thank you for being willing to protect yourself and your family from poor investment decisions. I wish you a secure, comfortable, and joyful retirement. You've worked hard for it. You deserve every moment of it. Take care.